Imagine living in a world where splurging trumps saving, where the allure of instant gratification outweighs the prudent path of financial foresight. In this reality, credit card debt skyrockets to unparalleled heights, and astonishingly, even those earning $250,000 annually are trapped in the paycheck-to-paycheck cycle. But amidst this widespread financial frenzy, a question looms. Is there a silver lining for the prudent few who resist these temptations? Or is our economy precariously perched on a foundation that requires widespread financial recklessness to thrive? Join us as we dissect this complex tapestry of personal finance, where responsibility and indulgence collide.
Hi.
So get this, a new report says 2 in 5 Americans think credit card debt is embarrassing.
Loans and credit cards. Tom Costello is now on the growing economic uncertainty and what you need to know about dealing with debt.
A majority of Americans can't afford a $1,000 expense without going into debt.
As it turns out, we're spending almost $18,000 a year on non-essentials.
There's a new survey out revealing baby boomers are unprepared for retirement, having less than half of what they'll need in savings.
And a recent survey from Edward Jones shows more Americans than ever are this close to a financial disaster.
Are you a beacon of financial prudence in a sea of spending spree enthusiasts? The current landscape of consumer behavior presents a paradox. If everyone embodied financial responsibility, the cascading effect on the economy could be drastic. The spending on everyday luxuries and non-essentials, from upscale dining to trendy gadgets, fuels job creation and economic activity. Yet, this raises a thought-provoking question. Does being financially responsible inadvertently stifle others' opportunities to achieve the same? As we peel back the layers, we find that the average American's financial situation is far from rosy. Post-pandemic savings have dwindled, replaced by mounting credit card debt. But is this merely a tale of fiscal recklessness or a harsh reality for those struggling to make ends meet? Financial prudence is not just a matter of choice for many, it's a luxury they can't afford. True financial responsibility encompasses more than just frugality. It requires significant investments, emergency funds, retirement savings, owning a car outright, and even a substantial down payment for a home. But let's face it, these milestones are steep hills to climb for a significant portion of the population. Remember the pandemic-era saving spree? A 2021 survey revealed ambitious saving goals: emergency funds, retirement, home down payments. Fast forward to 2023, and Bloomberg reports a grim reversal. The cushion of pandemic savings vanished for all but the top 20% of earners. Confronted with such bleak prospects, many turn to high-risk ventures in hopes of a financial windfall. Lotteries, get-rich-quick schemes, and volatile investments become the last resort for those who've seen the slow and steady approach falter. Poverty perpetuates a costly cycle. Food deserts and lack of access to affordable big-box retailers force many into paying premium prices for basic necessities. And then there are those who have the means but lack the wisdom, fueling the content of financial gurus like Dave Ramsey. When we delve into the mechanics of money, particularly in the context of stock market investments, the scenario gets intriguing. Imagine a world where financial prudence is the norm, not the exception. Sounds ideal, right? But there's a catch, especially for those who are actively investing for their future. In a scenario where everyone embraces financial responsibility, we'd witness a surge in stock market investments. More individuals funneling their savings into stocks would naturally inflate their prices. On the surface, this seems beneficial for current stockholders. However, for those who plan on making ongoing investments throughout their careers, this shift presents a challenge. As stock prices escalate, they detach from the underlying business fundamentals and performance metrics. For a long-term investor, what truly matters is the intrinsic value and growth potential of the companies they invest in. High stock prices, driven by an influx of financially prudent investors, could make these investments less accessible and potentially less profitable in the long term. So, in a financially responsible world, the stock market becomes a double-edged sword. While existing portfolios might see an immediate boost in value, the pathway for continued and future investment becomes steeper. This paradox highlights a crucial aspect of financial markets: their sensitivity to collective consumer behavior and investment patterns. Let's have a conversation about this delicate balance. Are you in favor of a universally financially responsible society, or do you see merit in the current diverse spending habits? Share your insights in the comments below. And remember, for more thought-provoking discussions on money and investing, hit that like button, subscribe, and spread the word. Let's unpack the investment philosophy of Warren Buffett, the iconic figure in the world of investing. His actions in the market, particularly his knack for identifying undervalued stocks, set a precedent that many try to emulate. However, there's a twist in this tale of investment wisdom. When Buffett makes a move, the market reacts instantaneously, often inflating the price of the stock he's just bought. While this seems advantageous, Buffett himself isn't a fan of this phenomenon. Why? Because it hikes the price of a potentially good stock, making future investments in that company costlier. This situation isn't exclusive to Buffett. Imagine if everyone became financially prudent, channeling their savings into the stock market. The demand for shares would drive up prices, impacting your ability to build an affordable portfolio for long-term goals like retirement. The same logic applies to real estate. If everyone starts saving aggressively for a home, housing prices could skyrocket, making it harder for everyone, including you, to buy property. This scenario highlights the interconnectedness of our financial behaviors and the broader economy. Ironically, consumer spending, often on perceived non-essentials, fuels corporate profits. This spending keeps companies like Apple thriving, which in turn benefits you as a shareholder. So, the financial imprudence of others can indirectly contribute to your investment gains. Despite these complexities, there are compelling reasons to advocate for widespread financial responsibility. First and foremost, a financially secure society benefits everyone. It can lead to a more stable economy, less reliance on debt, and potentially more equitable wealth distribution. In recent years, subscription services have become a pervasive aspect of our daily lives, reshaping how we access products and services. From streaming platforms to software suites, these models offer convenience but at a potentially higher long-term cost. The subscription economy has ballooned by 435% in the last decade, with a projected market size of $1.5 trillion by 2025. The core appeal of subscription services lies in their accessibility. They remove the need for a large upfront payment, catering to those who might struggle with saving. However, this convenience often comes at a higher cumulative cost. For example, software like Adobe Suite, once available for a one-time purchase, now operates exclusively on a subscription model, impacting consumer choice and financial flexibility. The shift towards subscription-based models reflects deeper issues in consumer behavior and financial planning. The environmental impact of overconsumption is significant, with Americans using more than their body weight in products daily. A more financially prudent society might lead to reduced consumption, decreasing the environmental burden and potentially lowering environmental taxes. A transition towards more responsible spending could benefit businesses focused on long-term, sustainable products. Investments in solar panels, quality homes, and durable clothing could see a rise as consumers prioritize value over volume. This shift could also bolster social safety nets like Social Security, ensuring more robust support for those in need. As we reassess our consumption habits, there's an opportunity to redefine our work-life balance. A society that values quality and sustainability over short-term convenience could lead to a reduction in working hours, as the demand for producing useless junk diminishes. This could pave the way for a more balanced, environmentally conscious, and financially secure society. What are your thoughts on the rise of subscription services and their impact on our financial habits and the environment? Do you see a future where financial prudence and sustainable consumption coexist? Share your insights and experiences in the comments below. Don't forget to like, share, and subscribe for more thought-provoking content on navigating the complexities of today's economy. Together, let's explore a path to a more balanced and sustainable future.